Good afternoon, everyone. Thank you for joining. Welcome to this webinar on how investing works. My name is Duncan May. I work at Hargreaves Lansdown as a financial wellbeing specialist. As you can see, we of course look after your workplace pension. The session is being recorded, so if you can refer back to this at a later date should you wish to. If you do have any questions as we go along, please do make use of the Q&A function within Zoom. I'll do my best to answer any questions in there at the end. So in order to be successful investors, we don't need to be experts. We certainly don't need to watch the stock market every day or even every week, or even read the Financial Times, although this might help. If we have a good understanding of how investing works, we can be successful investors. So what this webinar will be looking at is what options we have for our money, what the different types of assets we can invest in, investment risk, how to manage investment risk and some common pitfalls to avoid when investing, and also some tips to start picking our own investments as well. Remember, of course, the information in the presentation is intended as information as opposed to personal advice. Of course, this might seem quite obvious, but before deciding whether to invest, we should think about what we're investing for, what financial goals we might have. Investing is ultimately a way of putting money away for the chance to have more in the future. But everyone's financial goals are going to be different. We do have lots of different goals throughout our lives, and these can be hard to balance. But some example goals we might have are a rainy day fund. So this could be money set aside for emergencies or when we want to treat ourselves. Other objectives are large purchases. So things like buying a house, the really obvious one, paying for a car, holiday. These are typically things we can't cover in our day-to-day spending, so we need to save up to buy them. Another financial goal is retirement. So we save through a pension to put money away to hopefully give us the lifestyle we want after work. And another one we might think about is overall financial resilience. This is more a wider financial goal. This is defined as roughly the extent to which our financial assets can cover us in the event of an income shock. So this encompasses things like an emergency fund and potentially purchasing certain types of financial protection. Where our goals are in the short term, i.e. roughly the next 5 years, we might be better off holding our savings in cash. That's because our investments can and will go down as well as up in value. But if we have goals that are further away, we might choose to invest for the potential to reach our goals quicker. Another reason we might choose to invest is inflation. So this is broadly the general rise in the price of general goods and services over time. So we need to think about the impact that inflation has, particularly on our cash savings. So cash, of course, money we leave in the bank or save with a building society won't fall, but it's not entirely risk-free. That's because cash typically will struggle to keep up with rising prices or inflation in the long term, which means that we can lose money in real terms. What we've got here is some examples of milk and a football ticket. So a carton of milk back in 1990 might have cost you 25 pence. Bring that forward a few years to 2018, that could cost you 44 pence. A more extreme example is a football ticket. So back in 1990, that might have cost you £5, whereas in 2018, £43. These are some quite specific examples, of course. The general rise in prices is measured by the Bank of England, so things like the Consumer Prices Index. So what I did is just had a look at the Bank of England inflation calculator to compare the cost of goods now compared to 1991, the year I was born. So as you can see, goods and services costing £100 back in 1991 could cost as much as £219.56 in 2020. Of course, that's quite a significant decrease in the purchasing power of our money. The other thing to mention here as well, as you can see, the inflation has averaged 2.7% per year over that period. Bear in mind that the Bank of England's inflation target is 2%, so we haven't necessarily seen significant inflation over that period as well. In short, when should we invest then? So typically when we want to achieve a higher return than when we can with cash, when we don't need the money for say 5 to 10 years, ideally longer. And after, of course, as well, we've saved an amount of cash to cover us in the event of emergencies. Things like our emergency fund should typically be held in a savings account, which is easy access, so we can get our hands on it should we need to. So then we now have to think about investment risk. So we don't have a perfect definition of what investment risk is. Investments, the general consensus is that investments go down in value as well as up. So the risk to us is that the investments might go down in value, but might not rise again, or might not rise again in time. So we could get back less than we put in. So what options do we have for our money? Different types of investment or types of asset have different levels of risk and different levels of potential reward. So cash, firstly, cash we leave in, say, a bank account or a building society isn't going to go down. There is little potential for us to grow our money over the long term. In fact, the longer we leave our money in cash, the more likely it is to go down in value in real terms due to inflation. So the other types of asset we'll look at are bonds and shares. So firstly, bonds, this is where we effectively become the bank. So when you're buying a bond, you're essentially loaning money to a company or a government. Companies and governments issue bonds to raise money from investors, to raise funds. And in return for buying a bond, you receive interest, and also the issuer will promise to pay back the loan on a specified date. Bonds are technically higher risk than cash. That's because there is a possibility with a bond, as opposed to with cash, that the issuer could default. And as a result, the value of bonds can rise and fall because they are also traded on the bond market. But they are generally considered less risky than shares. The risk of different types of bonds can also vary as well. So, for example, a government bond issued by government in an emerging economy, you might say that they're more likely to default than perhaps a government in a more developed economy. So as a result, you might actually get a slightly higher rate of interest, but also a higher risk of default as well. Final asset class will compare as shares. So you might have heard these referred to as other things, so stocks and equities or other common names, all referring to the same thing ultimately. When you're buying a share, you're buying a slice of ownership in a company. Shares are listed on the stock market, so they're bought and sold on the stock market. You might do well by investing in shares. If the company does well, the share price might go up. So simply the price at which investors are willing to buy and sell the shares at. But if the company doesn't do well, the share price could drop. Or if a company goes out of business, for example, you can lose all of your money again as well. So there is a possibility with investing in an individual share of losing 100% of your investment. Share prices are also more affected by what's going on in the news effectively on a day-to-day basis. So that's what we refer to as short-term noise, which we'll come on to a bit later on. So you might have seen this next slide before. This is just comparing how those different types of asset have performed over the last 25 years. So of course, starting off with cash, relatively steady, but over the long term, unlikely to keep up with inflation. So in the short term, you might accept a small amount of inflation with the security that that money will be there where we need it. But over the long term, we might choose to invest to give us a potential to beat inflation and also to potentially grow our money as well. So bonds, as you can see, fluctuate more, but not to the extent at which shares do. So shares being that highest risk asset, highest potential reward. So if we want to grow our money, we do need ultimately to accept some level of risk. So it's really important, therefore, to then think about how we can manage risk and focusing on the things that we actually can control. So some things we can't control, the short-term noise. We don't know what's going on tomorrow, what's in the news. This can all impact the value of our investments. Similarly, we can't control how our investments actually perform as well. Stock markets are unpredictable. We're not going to get it right every time. The things we can control is firstly how well we diversified. Holding a mixed bag of investments could potentially mean we've always got something performing well. Another thing to think about is understanding how much of investing is based on human psychology. What happens around us can cause us to make decisions. That doesn't necessarily mean they're the right ones for our investment goals. The final thing as well is how long we remain invested as well. Ideally 5 to 10 years, but ultimately the longer, the better chance we have of getting a good return on our money. So talk about diversification now in a bit more detail. As we've seen, if you do invest directly in a share or a bond, there is a possibility you could lose all of your investment. This doesn't necessarily mean you should avoid investing in bonds and shares directly. Lots of people do very successfully. But if you are either a new or a experienced investor, funds are a good way to build a balanced portfolio. So when you invest in a fund, your money is pooled together with other investors. A professional fund manager will then invest your money into potentially a very wide range of different types of investments. They can invest in some of those on the right-hand side. So when you invest in a fund, you could automatically get exposure to anything between, say, 20 to a few thousand underlying companies or investments. The other benefit as well is you're delegating the day-to-day investment decision-making to a professional fund manager. Funds are designed to be held for the long term, i.e. 5 years or more, as we keep coming back to. So you don't need to monitor things on a daily basis. When you invest in a fund, you'll find that we often focus on a specific area called a sector. So example sectors are UK companies or UK smaller companies, more specifically. There are some sectors do give you a bit more freedom as well. So things like global funds can invest in any company globally. Mixed investment funds as well can again invest anywhere, but will have a fixed amount of your money in shares, the highest risk potential reward asset. So for example, a mixed investment 40 to 85% fund will hold between 40 and 85% of your money in shares. Stock markets are hard to predict. The best performing stock sector does change a lot. Past performance certainly won't guide you to the best performing area in the future. In fact, what we often see, as you can see on the slide, is that the best performing sector in the last year can easily be the worst performing in the following year. Very much investing is very much cyclical. So if you invest in just one area, it's likely to give you a bumpier ride and a higher risk of loss. So diversification is one way to help spread your risk and spread that risk of higher losses. If you have an online account with Hargreaves Lansdown, what you can do is use our portfolio analysis tool. This will show you where you are invested as a whole, so you can see what areas, some of which might be on screen, the ones you've covered, and also which ones you might be missing as well. So just to summarize on diversification, then you don't need to have money in every single area, just be absolutely clear with that. But do try spreading your money across some different sectors and assets. Having a good mixture of investments reduces risk and the potential for higher losses. Also, some funds, again, invest quite specifically, some more freely, and some funds can provide you with a lot of diversification in themselves, either by investing in quite a large number of underlying companies or simply investing in other funds, which in turn invest in different areas as well. Too much diversification, of course, can drag on performance though, but less diversification certainly does mean higher risk. We'll have a look later on at an example portfolio, which you might find useful for reference. A couple of things we'll look at here is just some investing behaviors now. So again, coming back to this thing, focusing on the things we can control as opposed to those that we can't. Remember, we're not going to get it right every time, but we can think about how we might react to the things that do happen around us, to the value of our investments in the short term. If you're investing something in hope that it's going to be worth more tomorrow than it is today, we'd say that is effectively gambling. You pretty much have a 50% chance of getting it right. We do see examples of this, or we'd say like herd mentality or FOMO, fear of missing out, in the stock market as well. It's really common to see investors move towards what is the most current, best performing sort of fashionable stocks, not necessarily because they're a good investment, because people are more likely to be worried that they're going to miss out on profits that other people are making. They might see other people, friends, talking about what they're investing in. So one really good and clear example of this is the dot-com bubble. So back in the late 90s and early 2000s, what we saw is that thousands of investors ended up investing billions of pounds into small technology-based companies in the hope of cashing in on the internet boom. A lot of these startup companies ultimately ended up not living up to their hype, and investors lost patience. And as you can see, that US index, the NASDAQ composite, which is quite heavy in technology companies, rose and fell by over 200% between 1997 and 2002, ultimately surrendering all of the gains it made during the bubble. So some people will have made money out of this, but also lots of people will have been left nursing huge losses as well. Making investment decisions based on what the people are doing is rarely going to be a recipe for success. So don't feel pressured into investing in high risk assets, things just because you see other people doing it. Remember, investing should be for the long term and not get rich quick scheme. Another question we often get asked: so is now a right time to invest? Should I perhaps hold off and invest when the markets are lower? These are really difficult questions to answer. In fact, other than in hindsight, there isn't ever really a perfect moment to buy or sell an investment. And this is where we come back to time. The best thing to do for is simply invest for the long term. What we have here is an example of what the impact of missing the 10 best stock market days, UK stock market days over a 20-year period, so 2000 and 2020. As you can see, missing the best days can cost thousands of pounds in the long run. Admittedly, you would be pretty unlucky to miss all 10 of the best stock market days, but is it a risk worth taking? We'd say arguably no. So in reality, which way the market moves today, tomorrow, or next week shouldn't really matter if we are investing for the long term. This is what we mean by ignoring short-term noise. Now, choosing an investment. So here are some things to think about when choosing an investment. So firstly, of course, think about your risk appetite. This is very much personal. What's right for one person at a certain age and in probably quite a similar financial position could be very different to someone else. So think about how comfortable you are, seeing the value of investments fluctuate. Also think about how much you can afford to lose as well. The longer investment time frame, typically the more adventurous you can afford to be. Remember, of course, you can always make adjustments to your investments at a later date if you think you haven't got it quite right. So think about where a fund invests. Have a look at the sector reviews section on our website. This could be a really good starting point for your research, perhaps which sectors you might want to invest in. That can be found that in the fund section. Think about the fund management style. There's broadly two types of funds. You get funds that look to beat the stock market, so actively managed funds, or index tracker, also known as passively managed funds. They both have a place in a diversified portfolio. You can filter both through the fund search facility on our website. If you're investing in actively managed funds, even more so, it's really important to try and pick fund managers with a good long-term track record. Think about your own attitude to risk, as we discussed. Details of charges you can find on our fact sheet. So remember, index tracker funds come with lower ongoing charges. Actively managed funds will charge more because there's more ongoing work involved within the fund. That gives you the potential for outperformance, but also, of course, they can underperform and are likely to underperform from time to time. We definitely say is don't make decisions based on charges alone, but it can be useful if you are comparing funds with similar objectives, perhaps. Before making any investment decision, do read the key investor information document. You can find that under the key features and documents tab on our fact sheets. This will tell you more about the aim of the fund, where it can and can't invest, also key risk information as well. If you're new to investing, you might find our wealth shortlist useful as a starting point. So these are a selection of funds across all the major sectors that we've picked based on our research. We meet and speak with the fund managers regularly, so you will get regular updates from us if you invest in a wealth shortlist fund. So we'll tell you how we think the fund's doing and also our sort of more wider view on the sector it's in as well. If our opinion changes on a wealth shortlist fund, we'll also let you know why, and you'll have the option to switch. We'll have a look at our master portfolios tool in a second. That's some example portfolios based on different types of investor. We also have some sections online on index tracker funds and also responsible investments, so funds which take ESG and ethical considerations into the equation when investing your money. Finally, just access to the full fund range. There is over 3,000 funds on the platform. You can invest in shares and bonds directly. If there are funds that you want to invest in you can't find, do let us know. We may be able to add them, so get in touch with us. Send us either the full name of the fund and preferably an ISIN or a CDOC code so we can have a look. This is our master portfolios tool then. So this is some example portfolios picked by our analysts. So you can see we've got the medium risk portfolio here, so you put in how much you're looking to invest. The tool will then give you a portfolio suggestion and a suggested weighting. You can simply invest in it as it stands, but you can also tailor and amend it to suit your own preferences. You can perhaps take some from the different ones as well. So if you perhaps think you're more between adventurous and medium risk, for example, you can sort of use that as an example, use it to build your own. Also think about potentially using a core satellite strategy. We'll look in a second. The other thing I just mentioned here as well is that there's 8 funds on that. That's just an example. It's not necessarily the perfect number of funds. Do pick a number of investments that you think you can comfortably keep track of, and don't add funds to your portfolio unnecessarily. This is that core satellite strategy I was talking about. So this is a way of potentially building a portfolio. So firstly, how would it work? So the core starting off, that would typically be a fund or selection of other collective investments. These are designed to add as the bedrock to your overall investment portfolio. So they're not necessarily going to be the most adventurous or exciting performers, we'll say, but they're there to help provide diversification and a steadier return. What you can then do is add satellite funds or other investments around that for more diversification. So these can be, again, funds or individual shares that won't necessarily match your risk appetite on their own, but help to manage the overall risk level once added to your core investments. So these can be used to gain exposure to different types of investments, stock markets around the world you might not currently have access to or exposure to. Holding a good mixture of satellites and core should hopefully mean you've always got something performing well. So that does bring us to the end. Here's just some links or some areas for further research. So have a look at our Learn section online. This contains some really useful information on investment risk, diversification, and also how to review your investment portfolio as well. If you do have any questions, do get in touch with us, invest@hl.co.uk, or on the number on screen. Our help desk are open 6 days a week. I hope you found the presentation useful. Before going, if you could take a quick moment to glance over the important investment notes on the screen. Just to summarize, the presentation is intended as information as opposed to personal advice. Stock market-based investments aren't guaranteed and can fall in value as well as rise, and tax and pension rules can and do change from time to time. The benefits depend on your personal circumstances. I'll leave that up for a few moments. If you have any questions, do let me know. There's a Q&A function within Zoom. I'll leave that open now for a few minutes. Otherwise, then, thank you for your time. I hope you found the presentation useful.